What is the difference between gross margins and net margins, gross profit and net profit? This is the question that you don't feel comfortable asking a bookkeeper or a CPA, but you really know that you need to understand it as a business owner. You're in the right place because today we're going to understand it at a deeper level than you ever have before. First, I want to walk you through understanding the difference between gross margins and net margins. Then we're going to look at how to calculate both in your business. Finally, I'm going to show you how to make your margins even better than they are right now. All right, first you need to understand the difference between profit and margin. And this is really confusing because they get used pretty interchangeably, but they're actually different. Profit is a dollar amount. It's a number. Margin is a percentage. And this holds true for both gross profit and gross margins and net profit and net margins. So let's look at now gross margins, how to calculate them and what they mean. How do we calculate gross profit and gross margin? Well, we need to start with gross profit, which is simply income, or the money you make, minus your cost of goods sold. This COGS is a good acronym to learn. And it includes a couple of things. First, direct labor. Any direct expenses for people that you're paying to produce the thing or provide the service that you're selling. So people costs. Next, materials costs. So anything that directly goes into production of your product, or if you have some kind of deliverable, consumable within what you sell, then we would put that in there too. One note here, you need to talk with your CPA or your bookkeeper about what can legally go under cost of goods sold. Because sometimes they'll have specific rules that the IRS will allow when you're reporting cost of goods sold for tax purposes. From a business owner standpoint, I actually like to see a little bit more detail in my profit and loss statement under COGS than most bookkeepers will show me. Because I like to see, for example, if I have an employee that is providing a service, I would almost always like to lump them under cost of goods sold because I am selling their time. However, many bookkeepers won't split that out. So I like to, and I'll ask them to do that. But that gives me my gross profit. So next, let's see how gross margin is calculated from that. All right, so now if we have gross profit, we can plug it into this simple little formula to give us gross margin. So gross profit divided by income, so the total income that I had, gives me my gross margin. So for example, if I had 90,000 of gross profit, which means that I had 10,000 of cost of goods sold, right? 90,000 of profit from 100,000 of income, that would be 90% gross profit. Now, gross profit ranges widely between different industries, and if I were to give you one number to say this is what you need to hit, it would not fit your business, I guarantee it. So rather than focusing on industry averages, I actually like to compare against myself. How am I doing in my business and how am I improving my gross margins? Now, if you run a restaurant business or a manufacturing business or an e-commerce based business, you can go find specifics for your industry, but I always find it most useful to compare my last year with my this year. Hey, if you're finding value in this and you like us being able to draw this out on the board, will you just click that like button to let me know that you're finding it valuable? All right, next, let's look at net profit. So income, so all the money you make, minus your cost of goods, minus your expenses. That gives us net profit. The net profit number should be shown at the bottom of your profit and loss statement. They'll usually call it net income, which I think is totally confusing when it's a negative number, but that is net profit. So you'll notice that this is different from gross profit because we're actually taking out all your other expenses as well. Now, here's the thing about net profit. If you've watched any other videos on my channel, you know that net profit lies to you. It doesn't tell you the whole story about how much money has come in and out of your business. Check out our other videos to see that, but it at least gives us a good sense of this month from a tax standpoint. Income minus COGS minus expenses is our net profit. And then we just use the same calculation that we used to find gross margin to find net margin. So it's net profit divided by income equals net margin. So let's talk about good net margins in a business because this one is more broadly applicable to all businesses. If you are a small business, meaning you're doing let's call it less than $5 million a year, and you are significantly below 5% net margin, you're going to find it really hard to operate profitably and pay yourself what you want. Many small businesses are in the range of somewhere between 3% and 10% net margin. And I'll just tell you, it is hard to be in that range. Instead, I would love you to be between 15 and 20% or higher on your net margins. Now, it completely depends on industry and how big you get, but there are some industries where, for example, we can see 25 to even up to 40% net margin. That's really hard to do. It's also incredibly hard to sustain as you grow, but I want you to calculate right now, what is your net margin? What percentage of your money are you keeping at the end of the day? And you might be asking yourself, well, Alex, do I include my owner's salary in that or not? And that's a little bit of a sticky question because it depends on how you're taxed, if you're an LLC or an S Corp. But I'll just tell you, if you run yourself as an S Corp right now, then your profit and loss is lumping you in as a business expense through your W-2 salary right now. If you're not taking a W-2 salary and you just have an LLC, then I want you to look at what is the value. If you had to pay someone to do what you do, what would the value of that be? And count that as an expense and see where your net margins really are. Because the hard thing as an early business owner is if we're not factoring ourselves in as an expense of the business, it might look like business is hyper profitable. But then all of a sudden, if we take our payment out of that, we're not anymore. So just be careful with that. All right, so Alex, this is all great, but I look at my margins each month and they're totally different. Well, welcome to business ownership. You might have what we call roller coaster margins, where it's up and then down and up and then down. And how do you decide what your actual margin is? We take an average. My recommendation is to look at the last 12 months of your numbers. So look at a 12-month P&L, for example, to see what is my total net income divided by my total revenue. That will give me an average for my net margin. And at the end of the day, you want to feel like, I know that it's going to be different every month, but I need to smooth out that curve to see on average where I'm at. All right, now I want to show you the power of changing one number in your business and how it will result in you making so much more at the end of the day as the owner. So I want you to imagine a scenario where we have $100 of income. We've got $60 of cost of goods sold. So in that case, by the way, we would have a 40% gross margin. And we would have $35 of other expenses. So 100 minus 60 minus 35 would leave us with only $5 left out of every 100 we sell. And that would be a 5% net margin. Now, who wants to have a 5% net margin? Not me, unless I'm running Walmart, in which case it would be amazing. But for small businesses, we don't like that. So watch how we can make one change to one number that can significantly alter how much profit we were bringing in. So check this out now. We've made one small change that results in a huge savings at the end of the day. So we still have our 100 of income, but this time we're dropping our cost of goods just by a little measly, like 3%, right? Goes from 60 to 57. Our expenses stay the same. And now we have $8 of profit. Now you might be saying, well, it's only 8%. Yeah, but we just hopped from 5% to 8%, which is a 60% increase in our net margins. So one tiny change up here at the cost of goods level can trickle down all the way to you keeping much more of your profit because it doesn't change our other expenses. So for you, how can you take your gross costs, those costs of goods sold, and decrease them by just a little bit? Because every dollar that you can decrease up here results in an extra dollar of profit down here. And that can become incredibly powerful for improving your profitability. So if you like this stuff and you say, you know, I really want to get deeper on this. I want to see how do I smooth out those curves, for example, of profit month to month. And I really want to understand my numbers with one big nuance of understanding accrual versus cash basis accounting and how that affects your margins. Go ahead and click the link below. We've created a free gift for you. It's our Margins Masterclass, where we dive deep onto gross versus net margins at a level that we can't get to here in a quick YouTube video. And we give you some extra resources to really get a handle on these numbers for your own business as our gift to you. Thanks so much for watching, and we'll catch you in the next video.